Shall I stop sharing now?
And keep it sharing.
Yeah, you can keep it on the screen.
Okay.
We'll just start the seminar soon.
Okay.
Okay, good morning. Time now 8 o'clock, a few minutes after 8 o'clock in the morning in Tokyo, May 25th, 2022. Welcome to another edition of the World Bank Tokyo office online morning seminar organized by the team based in Tokyo. My name is Koichi Omori. I am Senior External Affairs Officer of the World Bank based in Tokyo. We organize these online morning seminars to introduce the latest report put together by the World Bank's team, featuring the World Bank specialists and economists joining from Washington and their locations for the presentation for the stakeholders and audience in Japan. Every spring and fall, we have 6 chief economist offices for the regional vice presidencies. Each one of them, every spring and fall, will publish the regional economic update. And then at our morning seminar programs, we are trying to introduce all of them when released. This morning, we are going to feature the Middle East and North Africa regional economic update, which was released about a month ago. Connecting us from Washington, we have 2 speakers. Let me very briefly introduce each one of them. First, we have Rachel Yuting Fan. She is the economist at the Office of the Chief Economist for the Middle East and North Africa region. Good morning, good evening to you, Rachel. How are you?
Good. How are you? Thank you for having me here.
Great. Thank you very much. And we also have Ha Gwen, who is the senior economist in the same office of the chief economist for Middle East and North Africa region. Good morning, good evening, Ha. Thanks for joining.
Good morning, Koichi, and good morning, everyone. It's really a pleasure to be here.
Thank you very much. For the next 30-40 minutes, we are going to listen to Rachel and also later Ha will join the discussion about the latest edition of the Middle East and North Africa the regional economic update, which is titled Reality Check: Forecasting Growth in the Middle East and North Africa in Times of Uncertainty. After their presentation, I'll read the question that we received from the viewers. If you did not have opportunities to send your question in advance, please send your question using the online form posted on the announcement page of this seminar on our website, or you can simply post your question on the chat section of the YouTube screen. I'll read your question after their keynote presentation, asking them to respond. With that, I'd like to formally invite Rachel to lead the presentation. Rachel, please.
Thank you so much. Thank you, Koichi, for having us here to share our most recent report with you and your audience. Good morning, good evening, colleagues, and thank you to everyone for being here with us today. My name is Rachel Yuting Fan, and I'm an economist at the World Bank MENA Chief Economist Office. It is my great pleasure today to present on behalf of the team on the MENA Economic Update for April 2022. The title is Reality Check: Forecasting Growth in the Middle East and North Africa in Times of Uncertainty. This report is produced under the leadership and intellectual guidance from Roberta Gatti and Daniel Letterman, our Chief Economist and Deputy Chief Economist of the World Bank MENA region. And the team is led by our senior economist, Asif Islam, and have the following authors: Christina Wood, Ha Guyen, Rana Lofty, Mena Mosa, and myself. So from our report, we have the following key messages. First one, with regards to macro outlook, is that uncertainty remains, especially with the onset of the Russia-Ukraine war and the pandemic. We forecast an uneven recovery under much uncertainty. So for 2022, GDP growth for the MENA region is forecasted to be 5.2%. GDP per capita growth is forecast to be 3.6%. If this forecast materialized, then GDP per capita for 11 out of 17 countries may not recover to pre-pandemic levels by the end of 2022. It is also important in uncertain times not to be overconfident about the region's growth prospects. So we provide a reality check on economic forecasts. We show that forecasts are more uncertain and overly optimistic for the MENA region. We also show that timely and credible data systems can improve economic forecasts. We provide some recommendations on data transparency in this report. So on the macroeconomic outlook, the Russia-Ukraine war has disrupted global supply of commodities considerably, especially for oil and wheat. And this makes the inflation, which was already high in 2021, even worse. On the left-hand side, the graph, we see that since the onset of the war, wheat prices and oil prices jumped significantly with much volatility. The war also added turmoil in an already tightening global capital markets. On the right-hand side, we have the 5-year forward inflation expectation, and this also increased during the war. If inflation expectations continue to rise and accelerated, this may compel central banks to raise interest rates more forcefully than previously anticipated. It is important to note that there is much uncertainty about the magnitude and the persistence of the shock, and it really depends on how this crisis continues to evolve. Effects of the war is depending on the type of country in the region. It might be easier to organize the impact to direct and indirect ones, as summarized in this table. Direct impacts refer to the first round effects caused by changing prices. We list direct impacts in the upper panel. The rising price of oil and food may improve trade and fiscal balances of oil exporting countries, but it would still negatively affect consumers in these countries. And for MENA oil importers and food importers, they will face deteriorating trade balance due to rising oil and food prices. The fiscal balances of MENA oil importers are uncertain, and this depends on two opposing forces. On one hand, they can still benefit from higher revenues from their state-owned enterprises in the energy sector. On the other hand, subsidies and cash transfers will increase following the automatic stabilizers. In addition, tourism declines from Russia and Ukraine, and this would also have a direct impact on MENA countries with large tourism sectors. For example, almost a third of Egypt's tourists are from either Russia or Ukraine. Indirect effects or knock-on effects refer to ripple effects on other markets, such as capital markets, as well as responses from governments, firms, and households. And these effects include such as financial instability, social unrest, reform delays, and diversion of humanitarian assistance from MENA fragile states. If we zoom in MENA for their trade in food and fuel, we can see heterogeneity across the region. This chart is based on data from 2019, and MENA oil exporters will likely benefit from higher energy prices through higher export receipts and this will improve their current account balance and fiscal balances this year. As you can see in the orange bars, fuel exports account for more than 40% of GDP in countries like UAE, Kuwait, and Libya. However, the market is expecting oil price to converge to $70 per barrel in the long run. So we should be aware of the long-term challenges of declines in oil revenues. On the other hand, red bars here demonstrates net food imports as a percent in GDP for each individual MENA countries. This cost for Saudi Arabia is around 2%, for Egypt was around 3%, and for Jordan around 6%. In fragile and conflict-affected countries, the dependence on food imports is more severe. You can see 7% for Libya and more than 9% of GDP for Yemen. Such high exposure in food imports can lead to high vulnerability in both food price inflation and food security. Unfortunately, food price inflation was already an issue in the region, even before the Ukraine war. This heat table shows how food prices changed compared to pre-pandemic levels, with food categories in rows and MENA individual countries in columns, and the prices are compared between February 14, 2020 and February 3, 2022, which is before the Ukraine war. Across the region, we can see food prices have been rising. In Djibouti, Lebanon, Syria, and Yemen all saw severe increases in food prices across the board, as you can see in these red columns, with specific food categories more than doubled, including meat for chicken in Djibouti and meat for cattle in Lebanon. Syria and Yemen experienced sharp increases in food prices across board, with most of the categories increased more than 30%, and some categories more than doubled. This increase in food and energy prices will disproportionately hurt the poor people because they spend larger shares of consumption on food and energy. As you can see in these charts, for example, Moroccan households in the top 10% income level spend only 26% of their expenditure on food and 6% on energy, and this compared to those in the bottom 10% income level, whose food consumption takes more than half of their expenditure, and energy consumption takes more than 10%, so they are much more affected by the food and oil price inflation. More recent data from Egypt and West Bank and Gaza suggest similar patterns. In Egypt, households in the bottom 10% income level spend more than half on food and energy compared to only 30% in the top 10% income level. Likewise, in West Bank and Gaza, households in the bottom 10% income level spend 46% on food and energy compared to only 34% in the top 10% income level. Another source of considerable uncertainty is the pandemic. The world is not yet out of the woods yet, and neither is the MENA region. Vaccines are an effective tool in building immunity against the pandemic. Vaccine rates vary considerably within the MENA region. In this chart, we have positioned each country globally based on its vaccination rate in the y-axis and its income level, represented by log of its GDP per capita in the x-axis. And we highlight MENA countries in red. While the GCC countries have some of the highest vaccination rates in the world, vaccination rates in the developing MENA countries remain much lower than countries of comparable income levels. An example would be the comparison between the 97% vaccination rate in UAE and the 1% vaccination rate in Yemen. With much uncertainties around, we have drawn these two charts to illustrate the World Bank forecast of the GDP per capita levels, which is arguably a more accurate measure of living standards than GDP per se. For both charts, we normalize the aggregated GDP per capita level in 2019 as 1 and illustrate its growth till year 2023. Growth in real GDP per capita for MENA is expected to recover to 3.6% in 2022. As you can see in the left-hand side chart, after this growth, MENA is barely back to its income level in 2019. And this is following the big drop in 2020 and a modest recovery in 2021. This growth is uneven among the country groups, as you can see on the right-hand side. The GDP per capita of GCC countries in red line is expected to grow by 4.5% in 2022, but will still be below its pre-pandemic level until 2023. The annual growth is 3.0% for developing oil exporters, that's in blue line in 2022, which will lift the living standards back to pre-pandemic levels. And for developing oil importers in the orange line, GDP per capita is expected to grow by 2.4% in 2022 and recovering back to its level in 2019. Among all 17 countries in the aggregates that we have available data, 11 of them will not be able to recover to its pre-pandemic level by the end of 2022, as measured by GDP per capita. I should also mention that not all MENA countries are included in the aggregates, and this is due to various difficulties in these countries. For example, Lebanon, with too much uncertainties, is not forecasted for year 2022 and beyond. And due to lack of data, Libya, Yemen, and Syria are also not forecasted and not included in the aggregates. It is also important to note that, like weather forecasts, projections of economic growth in the near future are rarely accurate. But as long as they're reasonably estimated, they're invaluable tools for both government and private sector for planning and preparedness. Release of forecasts could also move financial markets. And even for international organizations like us at the World Bank, we rely on forecasts to make decisions on lending programs. So if the forecasts turn out to be wildly over-optimistic, then the consequences can lead to economic contractions and poor planning from all stakeholders of the society down the road. The analytical findings of the report show that the MENA region, on average, has more optimistic and inaccurate forecasts than the global average. We also found out that the greater the volatility, the tougher it is for forecasters to forecast. And in MENA, the exposure of the region to commodity price shocks contributes to growth volatility. The presence of states in conflict is another major contributor. But data transparency can reduce forecast errors and provide significant gains for the region. Lastly, we also found out that the accuracy of growth forecast varies by the type of forecasters. We use the January release of World Bank's Global Economic Prospects, GEP, to represent World Bank forecasts, and the January release of the IMF's World Economic Outlook, WEAL, to represent IMF's forecasts. Now let's take a look at the details one by one. Globally, between 2010 and 2020, the average forecast error, that is, the difference between forecast growth and realized growth, is 1.3 percentage points for the January JEP forecast, that is the orange horizontal line, and 1.5 percentage points for the January WEAL forecasts, that's the red horizontal line. For the easing of presentation, we also refer to this forecast error as optimism. And vertical bars here show the comparison among different regions. The MENA region on average had the largest forecast errors among all global regions between 2010 and 2020. The MENA region growth forecast errors averaged 2.5 percentage points for the January JAB forecast and 2.9 percentage points for the January real forecasts. These are quite large, given that the MENA average growth rate for this period was only 1%. These positive forecast errors also indicate of an optimism bias. That is to say, institutional forecasters tend to predict higher growth rates than the realized growth rates. The absolute forecast errors are restricted to their positive values, which removes the direction of the bias. We refer to absolute forecast errors as the inaccuracy of the forecasts, as you can see in the right-hand side. Globally, the absolute forecast error is 2.5 percentage points for the January JAB and 2.7 percentage points for the January real, as you can see in the horizontal lines. It is also the largest for the MENA region. Between 2010 and 2020, the average absolute forecast error for the MENA region was 3.3 percentage points for the January JAB and 3.5 percentage points for the January real. These two panels are constructed from a common sample of countries retrieved from the IMF's real and World Bank's JAB. So the findings are not driven by differences in the sample composition. Even when 2020 is excluded, which leads to a smaller forecast errors across the board, the pattern remains. Global average forecast remains to be both optimistic and inaccurate, as indicated by the horizontal lines. And among the regions, MENA continues to be the region with highest optimism and highest inaccuracy, as indicated by the vertical bars. And this is the case for both forecast errors and absolute forecast errors. So what does this forecast error mean for our current growth forecast? For example, for the growth forecast for 2022. What you can see on the right-hand side chart is what the adjustment to GDP growth would look like if 2022 ends up like a typical year by applying the median of forecast errors between 2010 to 2020 for each country. So we start with the red vertical bars, which demonstrate the forecast of the GDP growth rate for 2022 for each MENA country. And this is from the January 2022 World Bank forecast. Then the gold triangles you see are the adjusted growth, which is the red bar minus the median forecast error for this country. The black intervals you see here are the suggested interval of possible values based on absolute forecast errors. So the upper bound is derived from adding the median of the absolute forecast errors to the January growth forecast, while the lower bound is derived from subtracting this median of the absolute forecast error from the January growth forecast. But let's keep in mind that 2022 is still quite uncertain. We still have the Russia-Ukraine war going on and not out of the woods from pandemic yet. So the bounds of uncertainty and optimism of the growth forecast for 2022 will largely depend on how 2022 turns out to be. So what are the sources of the forecast errors? For example, would economies with volatile growth rates harder to predict? And the answer is yes. Economies with volatile growth rates are harder to forecast because models would be struggling to account for wild fluctuations. This chart has divided our country year samples by their growth volatility, and the blue bars represent those country years with highest volatility in the previous 10 years, and red bars represent samples with lowest growth volatility in the previous 10 years. Here we see blue bars are highest in both left-hand side and right-hand side. This suggests that higher absolute forecast errors tend to be associated with countries that experienced a higher growth volatility. And this relationship is steeper for the MENA region relative to the rest of the world. This indicates a stronger relationship between forecasting errors and growth volatility in MENA. And in MENA, conflicts and exposure to commodity price shocks contribute to growth volatility. Armed conflicts can disrupt economies considerably. Physical and human capital are destroyed. Funds are diverted from productive users. And when conflict occurs, as it happens in many parts of the MENA region, data capacity will also be severely affected, and the extent of the damage would be difficult to measure. The MENA region accounted for 68% of global battle-related deaths from 2013 to 2017. So in this figure, we compare countries with no conflict events on the left-hand side to countries with internal conflicts on the right-hand side. Right-hand side is higher, especially for MENA, and this shows that economies experiencing conflicts are associated with larger forecast errors. And this is particularly accentuated in the MENA region, where countries in conflicts have larger forecast errors than other developing economies. Many economies in the MENA region are oil exporters and food importers. This makes MENA economies vulnerable to swings in commodity prices, and this leads to increased volatility in economic growth. The colored lines you see in the left-hand side chart depict the export commodity price index for GCC, non-GCC MENA, and rest of the world. This is a measure that captures both the fluctuations in international commodity prices and country exposure to commodity exports. And you can see that this index is most volatile for GCC countries, and even the non-GCC MENA economies experience larger commodity price volatility than the rest of the world. The right-hand side divided country year samples into 3 terciles by their export commodity price shocks. Similar as before, blue bars represent countries with the highest commodity price shocks, while red bar represent those observations with lowest shocks. You can see that countries with higher terciles of commodity price shocks also have larger forecast errors, and this relationship is accentuated in MENA as well. Other than growth volatility, conflicts, and commodity price shocks, a key finding of this report is that the availability and accessibility of quality and timely information plays a key role in forecast errors. The Statistical Capacity Indicator, SCI, measures the timely production of credible statistics and is a proxy for the degree of information that forecasters have available to them. So how has MENA been doing? According to the SCI, many economies in the MENA region are data deprived. They have lagged in their statistical capacity to generate information. The 2 charts here display the movement in data capacity in the MENA region. And the chart on the left-hand side shows that the SCI in developing MENA declined between 2005 and 2019. As of 2019, the developing MENA region had the lowest score of all the developing regions of the world. To understand how high-income countries perform, we draw the right-hand side chart using statistical performance indicators, as of 2019 against income levels. And MENA countries are highlighted in red for GCC countries and orange for non-GCC MENA countries. The trend line here shows the average SPI score given certain income levels. And you can see that all GCC countries and most of the non-GCC MENA countries are below the trend line, so have worse data capacity compared to countries that have the same income level. Here we employ econometric techniques to explore the strength of the relationship between growth forecast errors and key variables, such as data capacity and growth volatility, while accounting for several factors. We use World Bank SCI to measure data capacity. The statistical capacity indicator measures the timely production of statistics. And what you see in this chart is the plot of estimated coefficient of SCI from 3 different regressions. The first one uses the forecast from World Bank, the second one from the IMF, and the third one from consensus forecast. Other than the difference in the forecasters, the regression specification is the same. The dependent or outcome variable is the absolute growth forecast error. In other words, the inaccuracy of the forecasts. A key variable of interest is the SCI, and other variables include the log of real GDP per capita, commodity price shocks, internal conflicts, country size measured by total population, and whether the economy is experiencing an economic boom or not. And year fixed effects are also included. The results here show a negative relationship between SCI and absolute forecast errors. The estimated coefficient is roughly around negative 1.6, which means that a 10% increase in SCI scores could translate into 0.16 percentage points decline in the forecast error, which is more than 10% of the median absolute forecast error. We also looked at some macroeconomic indicators ourselves, using information compiled from the websites of various statistical offices or data portal initiatives, central banks, and ministries of planning, economy, or finance across MENA region. And this table presents the availability of high-frequency data on GDP, industrial production, and unemployment for 19 economies in the MENA region. The date of the most recent data available is also indicated. We then benchmarked these observations against Mexico, which serves as a good comparator for the MENA region because it is an upper middle income economy and it also suffered from the COVID as well. If the country meets Mexico's standard, then the cell will be highlighted in green and otherwise in red. As you can see in this table, regarding GDP in the first column, 15 out of the 19 MENA countries report quarterly data, but some economies lack information for the year 2020 entirely. Economies in conflict, such as Libya and Yemen, have severely outdated data. And regarding industrial production, only 10 out of the 19 MENA economies have monthly or quarterly information, and among them, many are outdated. Regarding unemployment, only 8 economies report quarterly unemployment data, and none have up-to-date monthly data. So let me conclude by taking all our findings together in this conclusion slide. The World Bank forecasts that a growth of 5.2% for the MENA region for year 2022. If it materializes, then 2022 would experience the fastest growth since 2016. However, uncertainty remains. In addition, based on our analysis, we should expect forecasts to be uncertain, and possibly biased upwards. Unfortunately, optimistic forecasts can lead to over-indebtedness and future economic contractions. And to solve this problem, one practical and low-cost way to do is through improving data transparency. Thank you so much again for being here today and joining us in sharing our findings from this new report. Thank you.
Thank you very much, Rachel, for your presentation summarizing the key and main findings of the MENA Regional Economic Update, which was released just last month. We received several questions from the audience. Let me read those questions asking Rachel. And from now on, I understand Ha will also be joining the conversation. So we'll ask Rachel and Ha to make a comment on the questions that we received from our viewers. First question. Slide number 8 shows the diversity in the region in terms of vaccination rates. For the countries with lower rates, would you please mention the current pace of the rollout in such countries? Is it improving rather quickly being rolled out, or the pace continues very slow? It is worrisome if the pace is not accelerating. So if you have any comment or response to this question, Rachel and Ha, please. You are muted.
Okay, now you can hear me. So we don't have a very positive numbers, unfortunately. For many countries, the vaccination rate is still low. We don't see it accelerating for now. And our office has been keeping a tracker of the COVID situations in the MENA region. We trace the cases, the death rate, vaccination rate, etc. And from our tracker, the latest version being May 16th, we can see that many countries are still even below 10%, the vaccination rate. For example, Syria is 8.6%, and Yemen is 1.4%, and this data is as of April 19th, which shows it's already outdated. We also see, for example, Libya is 16%, and this data is as of April 14th, the latest data we have, so it's also outdated. Djibouti and Algeria are both worrisome. Djibouti has a vaccination rate of 12%, and Algeria has a vaccination rate of 14.5%. So these are all still worrisome. I'll stop here.
Yeah, may I echo Rachel's point that in addition to low vaccination, in many SCVs, MENA countries, those countries are also lacking behind in terms of reporting the numbers. That's also a difficult issue, because without knowing the number, then we don't know where they are in terms of vaccinations to provide support. I stop here.
Thank you, Rachel and Ha, for your responses. Let me continue reading the second question. Technology and digital development are often seen as a potential driver for economic growth. How does it fit into your analysis, and how do you see the roles of technologies and digital development in the current MENA region? Rachel and Ha, please.
Thank you, Kochi. Although this is out of the scope of this report, but it's a very important point, and our office have various research on this. For example, to start with, Ha and I and Rabah we published a paper on the review of development economics, and we use econometric models to find out that the MENA region have experienced a relatively slow pace of technology adoption in general purpose technologies, and a slower adoption pace of technology is associated with significantly lower economic growth. And we also show that the barrier to the adoption of general purpose technologies are related to the lack of competition in key sectors, for example, telecom sector. And it might lead to what we observed in the MENA region, which is the average rate of economic growth in the MENA region has not only been significantly lower than that in the East Asia, but also tend to drop at an earlier level of the income. And our office has also recently released a flagship report on the digitalization. And this report offers a policy agenda covering 3 fundamental pillars of the digital economy: telecommunications, infrastructure, financial sector, and regulations for e-commerce. And I encourage you to take a look at our report. And thirdly, I would also like to mention that in our last MENA economic update on the health economics, we mentioned that it's common across MENA regions being lack of reliable, high-quality digital data to inform transparent and accountable decision-making. And this kind of data are essential to, for example, health and other public service delivery. This means that it is urgent for the region to overhaul data systems as part of, for example, health systems reform, and to encourage a culture of openness and data use to inform policy actions. In an uncertain environment with the potential for new mutations of the coronavirus, that data should become even more relevant. I'll stop here. Thank you.
Thank you, Rachel. Rachel has covered many fronts on the issue of technology, the adoption and growth. And I have provided the links to our newly released report on the upside of digital for Middle East and North Africa. You are much welcome to take a look of the report. There in the report, we lay out what we call a digital paradox in MENA, meaning MENA countries is adopting social media higher than income peers in the world, but much lower in terms of digital payment. And that's the authors of the report termed that as a digital paradox. And they go to explain, why that could be the case and what is the policy implications for that. And the second piece of research that Rachel just shared is a publication with between us and our former chief economist for the region, Rabah Reski. So in that paper, and I have also shared a link to the paper. We lay out 2 findings. The first is that MENA countries, on average, has a lower growth in GDP per capita compared to other regions, particularly compared to EAP. EAP is famous because of the worries of middle income trap. As a countries like Malaysia and Vietnam was talked about, and we say that in fact MENA is even have a lower growth in compared to the same level income compared to the EAP. And when MENA countries become having higher GDP, the GDP per capita become much smaller compared to other regions. And one of the reasons we argue in that paper is that MENA have a relatively lower pace of technology adoption. So to answer the question, yes, we believe that technology adoption is very important for growth, and MENA is lagging behind compared to other regions. Thank you.
Thank you very much, Rachel and Ha, for your responses. I have tried to share the links that Ha just shared with me on the YouTube chat section, and then later we'll add the link also on the announcement page of the seminar, so people can take a look at the those report and publications. Next question. Let me continue with the third question. What does the World Bank do to help the MENA countries to improve the data transparency? Is it being done as part of the lending program or by separate capacity building programs? Would you please share the examples? Any comment, Rachel and Ha, please? Thank you.
So Rachel, may I come in and take this question, and then you come in and compliment. So thank you for the question. I think this is an important question, and this is exactly why we're doing this report. I think there are two issues about data transparency. The first is capacity. Many countries in the regions, FCV countries, and then they lack the capacity to produce good data. And the World Bank I think is doing support, assistance, and funding in some cases, with regards mostly on the micro data side, such as labor force survey, household surveys. We conduct many assistance, capacity assistance to these countries. For about the specifics, we have to come back and check with our operation side, so we can come back and report to you about the specific of the operation. So that's the capacity side. Now, the other issues is the willingness side, right? So many countries in the region, so GCC, for example, they are high-income countries, and capacity or resources is not an issue. It's more on the willingness to share data. And as you may know, the GCC, for example, they have micro level data, but they're not sharing it outside the country. So the World Bank, for example, we do not have access to these data sets. And that speaks to the issue of the willingness to share the data to a broader economic resource community and policy making community. And this is, I think the report is trying to speak to that. So in our report, we say that, look, data capacity, data openness matters in a big way. Matters matters for your economic planning, and the growth forecast is the most obvious example of your economic planning. And we show rigorously that the lack of data openness, that the lack of data capacity can hamper your ability and other people's abilities to forecast growth precisely in the country. And it has implications down the line in terms of planning, of fiscal planning, of bordering planning, and therefore it can hurt growth. So the report is also a way, if you can think about it, it's a way for us to help country think through why data openness and data capacity is important, and we try to do our small part in the conversation with the country. Thank you.
Yeah, I echo Ha's response, and let me also take this opportunity to pass on the messages from our country economists in their recommendations that can help the most for the countries in the region. They have made 4 main suggestions, and number 1 is for countries to try to have a high frequency and better quality of national accounts data, and 2, to have better communication between ministries and the national statistical offices. And 3, I believe the IMF and the World Bank are also providing technical assistance to governments to improve national statistics. And then lastly, but not least, for countries in conflict, the availability of alternative data sources is also very valuable, not only for our research, but also for stakeholders to make evidence-based decisions. Thank you.
Thank you very much, Ha and Rachel, for your responses. We received a comment and question from the audience posted on the chat section of the YouTube screen. Let me read those and asking you to respond. First one, the comment from Arthur. Thank you very much for your comment. Interesting revelations, quite informative, well researched and articulated. Thank you, Arthur, for joining the presentation. We received a question from the Professor Shimamoto from the Kyoto Bunkyo University. Let me read his question. Interesting notes on optimism gap. Sorry, optimism gap. Are there any exchange of ideas to minimize the optimism gap between world economic outlook and global economic prospect? If so, any outcome? If you would like to make a comment, Ha and Rachel, on this point, please go ahead. Thank you.
Ha, would you like to come in?
Yeah, thank you, Rachel. I like, yeah. So, let me start by saying that the finding about optimism is well established. We're not the first one to establish the fact that forecast is in general more optimistic. So forecasts tend to be higher than actual forecasts. And it has been a very established finding from many researchers, including the people at the fund. And the longer the forecast horizon, the higher the optimism bias. So I don't think there's any controversy there. You know, there can be a couple of reasons for that. You know, people, you know, we forecasters, sometimes we take information from the government, and sometimes the conflict of interest, you know, with the business, with the public sector, and so on and so forth. So it may be influenced by the government views, and sometimes the government views are also biased because of many other reasons. So that is one thing. Second thing is the comparison between the fund and the bank, and this is, I think we are the first to uncover that the bank is a bit less optimistic compared to the fund in terms of forecasting. The difference is really small, about 0.2% on average. So on average, you can say that the bank and the fund have roughly similar forecasts. The bank is slightly less optimistic, but we don't have a good reason to explore why that could be the case. We don't have a theory, but via sort of informal conversations with country economists and with private sectors that we consult, it could be the case. And this is again not our thinking, but just an idea there that, you know, we haven't tested out, that the fund sometimes have programs with countries, and those programs requires somewhat optimistic forecast about the GDP growth, so you know they can prove that the program they put in play could be working. So that's just a theory put up by private sector forecasters, and I think this definitely requires more investigation and careful examination to find out the reason between the difference between the fund and the bank, although the difference is, I would say, very small in my opinion. Thank you.
Thank you very much. We'd like to thank Rachel and Ha to give us the presentation, and also response to the question that we received from the audience. Thank you very much. Before wrapping up the seminar, I would like to invite Rachel and Ha to give us a very final remarks. Then we wrap up the seminar. So Rachel, please, if you have any final remarks.
Thank you so much, Kochi. Let me just take this opportunity to thank you so much again for the opportunity to share our report with you and your audience. We're very honored to be here every time. Thank you so much.
Yeah, same with me. And I also want to thank very interesting questions, insightful questions, and it's really appreciate the opportunity to engage with you and people in Japan. Thank you very much.
Thank you very much. This morning, we had a pleasure of having Rachel Yutney Fan, the economist, and Ha Gwen, senior economist, both from the office of the chief economist for North Africa, Middle East and North Africa region of World Bank. Thank you very much for your time joining us this morning. Really appreciate it. Thank you.
Thank you.
Great, thank you very much. So next week, we are going to, not next week, this week, we have another morning seminar. This is going to be held on Friday, 8 a.m. This week. We are going to feature the South Asia economic focus, which is the South Asia version of the regional economic update. With this Friday seminar, we are going to be completing our journey this time for going through the 6 respective regions in terms of the regional economic update. With that, I would like to say once again, thank you very much for joining. I will see you on Friday morning. Stay safe, stay healthy. Thank you very much.
Thank you. Bye-bye.
Thank you.